Welcome to the deep dive. Today we're really digging deep into a metal with, well, an incredible past and maybe an even more intriguing future. We're talking about silver, specifically as an investment.
And we've got quite the stack of source material here. It's pretty comprehensive analysis covering, everything from its history over millennia, market mechanics, its vital role in modern tech.
All the way through to the different ways you might actually invest in it.
So our mission today is pretty clear. We want to sift through all this information and pull out the absolutely essential insights, maybe some surprising facts, and the key takeaways that, cut through some of the noise out there.
Yeah, the goal is really to help you get a properly well-informed perspective on silver's unique position in the whole investment landscape. Understand what role it could potentially play in a portfolio.
And there's this core tension, this duality that we really want to explore today.
Right, silver isn't just some dusty relic of old money. It's actually fundamental. It's woven right into the fabric of tomorrow's technology.
Exactly. That fascinating mix, old money meets future tech. That's what makes silver so compelling, I think. So, yeah, let's dive in.
Okay, so starting with silver's story, you really have to go way back. I mean, this isn't something we just stumbled upon recently.
Oh, not at all. It's been part of human civilization for thousands of years. Its oldest, most enduring role. Basically a fundamental store of value and a universal means of payment across huge parts of the world.
It's an incredibly deep history.
Think about the major economic systems centuries ago. Europe, say 15th through the 18th century. Silver coins, silver bullion, absolutely critical. But it wasn't just the West.
No, China, the Middle East.
Yeah.
Major economies there relied heavily on silver as their primary currency, too.
Right, and that lasted well into the early 20th century in some places. Even the early United States, trying to set up a stable financial system, went for a bimetallic standard back in 1792. Legally fixed silver to gold, 15-to-1 ratio.
And what's fascinating is how this wasn't just like dry economic policy. It became real political drama.
Yeah. Oh, definitely. You look at the late 19th century, the populist movement, figures like William Jennings Bryan, his famous Cross of Gold speech in '96, that wasn't just talk.
No, it was a fiery argument for the free coinage of silver.
Exactly. He saw silver as the key to boosting the money supply, helping struggling farmers by raising prices, sparking economic growth, especially for the Western mining states. It shows just how strong that belief was that silver could drive prosperity.
But that era, that was kind of the peak of its direct monetary role in the modern sense.
Yeah, pretty much. The 20th century brought a huge shift. By, say, 1935, most major nations had basically abandoned silver as official currency. Even policies meant to help silver, like FDR's Silver Purchase Act in the 30s.
That was complicated, wasn't it?
Very. Framed as economics, but a lot of historians see it more as a political move, shoring up support from those powerful silver mining states during the Depression. Its actual impact on the wider recovery, probably limited compared to things like banking reform or gold standard changes.
And those U.S. silver purchases in the 30s, they actually had ripple effects overseas. It's a good reminder of how connected markets are.
Huge ripples. By buying up so much silver and pushing the world price up, the U.S. policy basically triggered deflation in China, which was still on a silver standard then.
Wow. And some analysis suggests that instability might have even weakened China and helped Japan's expansion before World War II.
It's a connection some historians draw, yeah. An often overlooked consequence. And domestically, some of that stockpiled U.S. silver actually ended up being used in critical wartime efforts, even in the Manhattan Project, because they needed its conductivity.
Fascinating side note. But after World War II, the game really changed for silver.
Fundamentally, industrial demand just started climbing. Steadily, consistently. It gradually but decisively started to overshadow silver's old monetary role.
Because the metal itself was becoming more valuable for industry than its face value as a coin.
Exactly. Less and less reason to mint coins with high silver content. That was the slow, practical demonetization happening right there.
So if you zoom out from all that history, what's the key takeaway for someone looking at silver today as an investment?
I think it's this idea of monetary memory. Even though it's not everyday money now, or held by central banks like gold is, that millennia-long history as value is just baked into how investors think about it.
So when things get shaky financially, or currencies wobble, or inflation fears rise,
that historical memory kicks in. People instinctively look to silver alongside gold as something tangible, something outside the conventional system, a perceived safe haven.
right. And the history also clearly shows that government policies can really move the needle in the silver market, sometimes in unexpected ways.
Absolutely. And that perceived value, that history, it's all deeply tied to silver's pretty amazing physical and chemical properties. It's not just shiny.
No, beyond the obvious beauty, that bright white luster that makes it great for coins and jewelry, it's the technical stuff that really drives its modern importance.
It's incredibly workable, right? Malleable, ductile, you can shape it, draw it into fine wires, flatten it into sheets. But the property that makes it just indispensable now is conductivity.
That's the headline. Highest electrical conductivity, highest thermal conductivity of any metal, period. It's not even close.
And it resists oxidation pretty well, although it does tarnish with sulfur.
Yeah, that familiar tarnish, it reacts with strong acids, and it's a really effective catalyst in some major industrial processes, like making ethylene oxide.
So let's connect those properties directly to value. Beauty and workability explain the historical use, coins, jewelry, investment bars today.
But that unmatched conductivity and thermal transfer, that's why it's absolutely critical in high-performance electronics, electrical contacts, solar panels.
Its stability being relatively noble, combined with that conductivity means, even if copper is cheaper.
For applications where reliability and top efficiency are non-negotiable, silver is often the only real choice, where failure just isn't an option. And it's relatively rare, too. More common than gold, but still scarce compared to many industrial metals.
About 0.05 parts per million in the Earth's crust. So, yeah, limited availability definitely contributes to its value.
Okay, but here's what seems like a really critical point. Maybe the most unique thing about silver's supply side. Most of it doesn't come from silver mines.
This is absolutely key. The vast majority, we're talking 70, maybe 80% of new silver supply is a byproduct.
Meaning it's dug up alongside other metals.
Exactly. Primarily lead, copper, and zinc. Miners are going after those base metals, and the silver just comes along for the ride in the same ore. It gets recovered as part of that process.
So the amount of new silver hitting the market isn't driven primarily by the price of silver itself, or even silver demand.
Largely no. It's much more tied to the economics and demand for lead, copper, and zinc. Think construction, manufacturing.
Right, so if silver demand certainly spikes, but say copper mining is slowing down because construction is weak, you can't just easily ramp up silver production.
Precisely. The supply is inherently inelastic. It doesn't respond quickly or strongly to its own price signals like a primary mined metal would.
And that structural inelasticity is crucial. Why?
Because it means when silver demand does surge, or if there are supply disruptions, that lack of quick supply response can amplify price moves, especially upwards. New supply just can't easily meet that sudden demand spike.
And demand is surging, especially industrially. Which brings us squarely into silver's modern role. This is the future tech side of that duality we talked about.
This is where silver really earns its keep today. The data is clear. Industrial uses are now the dominant demand source, consistently over 55%, and it's growing.
Yeah, the source mentioned record industrial demand, 680.5 million ounces in 2024, and that was the fourth year in a row of records.
4 consecutive record years for industrial consumption. That's a powerful trend.
What's driving it? The big picture seems to be the green economy transition.
Massive driver. Renewables, especially solar, EVs, upgrading power grids, all need silver. Plus, continued growth in consumer electronics, and now you layer on things like AI needing more advanced hardware.
Looking regionally, China and India saw increases in 2024, though the U.S. dipped slightly.
Right. And in the U.S. specifically, USGS estimates for 2024 put electrical and electronics uses at the top, around 29%, photovoltaics, so solar, at 12%, brazing solder 4%, other uses 7%.
And comparing that to just a couple years earlier, like 2022, you can see the share for electronics and especially PV creeping up.
It shows the trend. And here's a really striking fact that highlights how strong this demand is.
Go on.
Industrial demand is hitting these records, even though companies are constantly trying to use less silver per unit. That process called thrifting.
Right, like using finer lines of silver paste on a solar cell or smaller contacts, trying to save costs.
Exactly. But the sheer volume growth in things like solar panels and electronics is just overwhelming those thrifting efforts right now. Demand is climbing despite using less per item.
That really speaks to the underlying strength of these trends.
It absolutely does. Robust is the word.
Okay, let's drill into those key tech uses because this is the engine room. Solar, photovoltaics, that seems to be the big one currently.
Arguably the single biggest industrial driver right now, yes. Silver is essential. That high-purity silver paste, they screen print onto silicon wafers that forms the grid lines and bus bars that collect the electricity.
And there's no real substitute for that job in mass production.
Not really, not when you need that combination of conductivity, durability, and cost-effectiveness at scale. So yeah, the PV sector is the largest single industrial user globally.
And the growth numbers are pretty staggering. Didn't the source mention something like a 139% jump in PV silver demand projected between 2016 and 2025?
That's the kind of trajectory we're talking about.
Mhm.
And with global solar capacity expected to blow past 300 gigawatts in 2025, the sheer volume of panels being made translates directly into huge silver demand.
Okay, then there's the whole world of general electronics and electrical applications, AI, 5G, Internet of Things.
Silver's critical here too, again, because of conductivity. Conductive inks, pastes, films for circuit boards, connectors, switches, contacts.
In everything from our phones and laptops to the massive data centers running AI.
Right. 5G rollout needs advanced electronics for those high-frequency signals, often relying on silver. And think about the billions, literally billions, of IoT devices, sensors, smart gadgets. Each might only use a tiny bit of silver, but it adds up incredibly fast.
And AI boosting demand for high-performance computing just adds another layer.
Definitely. Electronics demand, excluding solar, was projected to grow around 19% just in that 2016-2025 period.
Electric vehicles, another huge growth area. And they use more silver than regular cars.
Significantly more. The source puts it at 25 to 50 grams per average battery electric vehicle, compared to maybe 15 to 28 grams in an internal combustion engine car.
Where does that extra silver go in an EV?
Battery management systems, lots of high voltage connections, all the sensors for things like ADAS, advanced driver assistance systems, even the charging infrastructure relies on it. Automotive silver demand overall is projected over 90 million ounces a year by 2025.
And just the EV portion, based on sales forecasts for 2025, could be over 27 million ounces alone.
That's the estimate. It's a major slice of the demand pie now.
Then there's medical and healthcare. Smaller, but consistent growth.
Yes, driven by silver's powerful antimicrobial properties. Silver ions kill bacteria, fungi, viruses.
So wound dressings, coatings on catheters, and implants to stop infections, instruments.
Exactly. That sector shows steady 3–5% annual growth typically. It's a reliable source of demand.
And we shouldn't forget other uses too. Catalysts for chemicals like ethylene oxide, water purification, RFID tags.
Wood preservatives, reflective coatings for mirrors. It's incredibly versatile stuff.
So what's the key analytical takeaway from all these diverse industrial uses?
I think the most critical point is just how non-substitutable silver often is in these high-performance roles, because nothing else matches its conductivity and reliability, especially where efficiency and dependability are paramount.
So even with thrifting efforts, completely replacing silver often isn't feasible without sacrificing performance.
Right, and often the actual cost of the silver in, say, an advanced electronic component or a solar panel is a relatively small part of the total product cost. So the incentive to switch to something inferior just to save a tiny bit on material cost often isn't there, especially if it compromises the final product's function or reliability.
Makes perfect sense. Don't skimp on the critical ingredient.
Exactly. And when you look at the bigger picture, you see this amazing convergence. All these massive global trends, green energy, electrification, 5G, AI, healthcare advancements, they all rely heavily on silver.
So it's not just dependent on one industry going well.
No, it's diversified across multiple powerful long-term trends. That makes its industrial demand profile look incredibly robust for the future.
So what do future projections look like for overall industrial demand?
Generally strong based on these trends. Some analysts see continued growth, maybe around 3% in 2025, potentially pushing total industrial demand over 700 million ounces.
Although the source did mention a slight nuance from the Silver Institute for 2025 specifically.
Yes, they suggested industrial fabrication might actually be kind of flat in 2025 compared to the record 2024 level. Their reasoning was a potential easing in the rate of growth for solar panel demand. Not a decline, mind you, just maybe not accelerating quite as fast as it has been, even while absolute demand stays incredibly high.
So a bit of short-term variation in forecasts, which is normal.
Exactly. Predicting the exact pace year to year is tough. But the long-term view, beyond 2025,
It seems solid.
absolutely. Those core drivers, decarbonization, electrification, tech integration, those are multi-decade trends. They provide a really strong foundation for sustained and likely growing industrial silver demand well into the future.
Okay, so all this demand interacting with supply and investment interest. that ultimately drives the price. And silver's price history is, well, famous for being volatile.
Volatility is definitely its middle name. Silver prices have seen some absolutely wild swings over the decades, driven not just by fundamentals, but also investment crazes, speculation, general market mood.
The most famous example has to be the Hunt brothers trying to corner the market.
Oh, yeah, the classic story. Late 70s, early 80s, they bought up enormous amounts of physical silver, huge futures positions.
And the price just went vertical.
From around $6 an ounce to a peak of nearly $49.45 on January 18th, 1980. Over 700% gain in a short time. But, those kinds of speculative bubbles rarely end well.
No, it crashed spectacularly. Silver Thursday, big losses for the Hunts.
Exactly. And we've seen other bursts of volatility more recently, too, maybe less extreme. Like around the 2010 U.S. midterms, price jumped from about $17 to $30.
Or in 2011, during the U.S. debt ceiling crisis, there was a spike from safe haven buying.
Right. These moments illustrate that key dynamic. Industrial demand provides a sort of baseline, but because silver is a smaller market than gold, it's much more prone to these amplified swings from speculation and sentiment shifts. These can be powerful, but often temporary.
And the lesson from market corner attempts like the Hunts.
I think it shows that trying to fundamentally manipulate or corner a market like silver long-term is incredibly hard. Market forces, regulatory actions, counter-pressures, they tend to push back. Even with modern concerns about paper market tactics, outright corners are historically difficult to sustain.
Okay, that's the past. What about right now, mid-June 2025? What's the current state of play?
Well, silver's had a very strong run lately. As of early June, spot prices were hovering around $36 and $27 a kilo. That's about $1,166 per kilogram. It was even a bit higher a few days before, hitting nearly $11,175 a kilo.
That's a big move up from where it was, say, early last year.
Huge move. The source notes it was trading in the $22, $24 range back in early 2024. It climbed pretty steadily through last year and into this year, and then made a decisive break above that key $30 level, pushing it to multi-year highs.
Looking at the specific data for that first week of June, high around $1,171 a kilo. Low around $1,067.
Yeah, which points to a really significant gain just in that 1 week, up over $91 a kilo, or about 8.5%. That's a big weekly move. And doing some rough calculations from the source data, year-to-date performance as of early June was looking like maybe 58% up,
Wow.
and the one-year gain around 24%. So yeah, really strong recent performance.
Those are definitely numbers that grab your attention. Where does that leave the market technically?
Right, at a critical point, actually. It's testing a significant zone of overhead supply or resistance, noted specifically between $35.77 and $36.12 an ounce. It's bumping up against multi-year highs.
So strong momentum meeting potential resistance,
Yeah.
an inflection point.
Exactly. Technical analysts are watching this very closely. A clean break above this zone could potentially open the door for further, maybe even accelerated gains. But if it fails to hold above here, we could see consolidation or a pullback. It definitely warrants close watching right now.
Given that strength, what are the analysts thinking comes next? Let's look at those future price predictions, maybe for the rest of 2025 and out towards 2030.
Okay, well, the general mood among analysts seems pretty bullish, which makes sense given the recent action and the fundamentals we've discussed. But, and this is a big but, the range of specific forecasts is really wide.
That tells you something about the complexity, right?
It absolutely does. People are weighing the drivers differently. So for 2025, you see forecasts like JP Morgan around $36, ANZ maybe $33 to $35. Mass are suggesting maybe $38 to $41. Citigroup and Saxo both looking towards $40.
And some are aiming even higher for this year.
Yeah, definitely. You've got Konoshko and Krauth talking $40 to $50. Investing Haven thinks a test of the all-time high, so around $49.50 is possible this year. Robert Kiyosaki's thrown out $70. Technical targets based on recent breakouts are often in the $42 to $45 range initially. The World Bank was more conservative, projecting maybe a 7% rise for 2025 over the 2024 average.
What are the common reasons cited for these bullish 2025 calls?
Usually a mix. Continued safe haven appeal, potential for the U.S. dollar to soften, ongoing supply risks or deficits, persistent inflation concerns, geopolitical instability, the usual suspects for precious metals.
What about looking a bit further out, 2026, 2027?
Forecasts get even fuzzier, naturally. Some see maybe consolidation around $50 in 2026 if we get a strong run this year. Investing Haven actually sees new all-time highs happening between 2026 and 2027. Alan Hibbard specifically targeted 2026 for breaking above the old $52.50 peak. There are lower targets, too, like $38 for 2026 and some generic forecasts. Investing Haven then sees it potentially pushing towards $77 in 2027.
And the really long view, out to 2030. The range must get huge then.
Oh, it does. You see a sort of consensus clustering around $80–$85 for 2030 from many experts. Specific targets mentioned include $56 from some analysts, $75 from Coin Price Forecast, BTCC suggesting maybe $75–$81, Investing Haven peaking around $80.
But then you have some really high outliers.
Yeah, Keith Neumeyer has talked about $100 silver in the coming years. Gold IRA explained projects $330. And there was an AI tool mentioned, priceprediction.net, throwing out a number like $337 for 2030.
Okay, that AI number is aspirational, let's say. What causes such a massive spread in these long-term forecasts?
It really highlights the uncertainty in the different models people use. How much weight do you give the industrial demand story versus the monetary safe haven angle? Some use macroeconomic models, some technical charts, some pure supply demand, some blend indicators like Investing Haven's 5 factors, gold bull market, inflation, euro dollar, futures positioning, physical shortages.
And the extreme high forecasts.
Those are usually highly speculative, probably assuming scenarios like hyperinflation or major currency resets or extreme market breakdowns. Most of the more grounded, optimistic forecasts rely on those big trends: green tech, electrification, persistent deficits continuing to play out strongly.
What could derail those optimistic scenarios? What are the risks?
Key risks mentioned include finding major new silver deposits unexpectedly, though that's seen as unlikely near term. Big technological shifts that allow widespread substitution for silver in key uses, or dramatically reduce the amount needed way beyond current thrifting. Or a really severe global recession that hammers demand for electronics, cars, new infrastructure projects. The path higher isn't guaranteed. It depends on these factors staying generally favorable.
Okay, let's try to synthesize all this. What are the absolute core drivers pushing and pulling on silver prices?
At the heart of it, it's supply and demand. And the source material really emphasizes one critical ongoing factor: a persistent structural market deficit.
Meaning demand has been higher than new supply for several years straight.
4 consecutive years, according to the data cited 2021, 2022, 2023, and 2024. That built up a cumulative deficit of around 678 million ounces by the end of last year.
A deficit like that, year after year,
Yeah.
that has to put upward pressure on price, doesn't it?
Fundamentally, yes. It implies that existing above-ground stockpiles held by investors, industry, maybe even in ETFs or exchange warehouses have been drawn down to meet that excess demand. Combine that with the inelastic supply we talked about, the byproduct nature, and this persistent deficit is a powerful underlying bullish force.
And industrial demand is now the biggest piece of that demand puzzle.
Absolutely. Over 55% now, up from maybe 40% a decade or so ago. That record, 680.5 million ounces used industrially in 2024. PV, electronics, EVs, 5G, medical directly links silver's fate to real-world economic activity and technological trends.
But investment demand hasn't gone away.
Not at all. Despite industry's rise, silver's history means investment demand is still crucial. People buy physical coins in bars. They buy silver ETPs as a store of value, a hedge against inflation, currency worries, system instability. This demand is very sensitive to sentiment, fear, even specific online campaigns sometimes.
And we see differences regionally, right? Like Western physical buying dipped in 2024, but India surged.
Exactly. Investment flows can shift geographically based on local conditions and sentiment.
Broader economic conditions globally must be a major factor too.
Huge. Inflation tends to boost interest in precious metals. Interest rates are key. Lower rates make holding non-yielding silver more attractive. The U.S. dollar strength matters, usually an inverse relationship. A weaker dollar helps silver. Economic growth fuels industrial demand, while a deep recession could hurt that side, but might simultaneously boost safe haven buying. It's complex.
Geopolitics always seems to move precious metals.
Typically, yes. Instability, conflict. They increase demand for assets seen as safe havens outside the traditional financial system. The conflict in Eastern Europe was noted not just for that, but also because Russia is a top 10 silver producer, raising supply concerns.
And because silver is a smaller market than gold, speculation plays a bigger role.
That's a really important point. Its market cap, daily trading volume, much smaller than gold's. This means large trades, shifts in sentiment, or coordinated speculative buying or selling can move the price more dramatically. Fundamentals drive the long term, but speculation can definitely amplify the short-term swings.
Let's talk about the gold-silver ratio, the GSR. It always comes up.
It's a vital comparison tool. Simple calculation. Price of gold divided by the price of silver tells you how many ounces of silver buy 1 ounce of gold.
And historically, when silver was money, that ratio was much, much lower.
Right, fixed by law often. Around 12.1 in Rome, 15.1 in the early US, 15.5.1 in France. The average for the 20th century was closer to 47.1.
And right now, June 2025, it's around 75.1, down from even higher levels recently.
Exactly. The source mentioned it had been over 100.1 earlier in 2025, which is considered extremely high historically. Many see ratios that high as a signal that silver is significantly undervalued relative to gold.
How do investors typically use the GSR?
A high ratio, say over 80.1 or definitely over 100.1, is often interpreted as a buy signal for silver relative to gold. The thinking is that silver is cheap and likely to outperform gold on a percentage basis going forward. A low ratio, maybe below 50.1 or 40.1, suggests the opposite, silver might be expensive relative to gold.
And does the ratio tend to revert back towards some average?
Historically, there's been a strong tendency for mean reversion when it gets to extremes. Those spikes above 100.1, like in 1991 or March 2020, were followed by periods where silver rallied much harder than gold, bringing the ratio down significantly.
We shouldn't expect it to go back to 15.1.
Highly unlikely. Silver's role has changed too much. It's primarily industrial now, while gold remains the pure monetary asset favored by central banks. So the mean it might revert to is probably higher than those old monetary ratios. But even reverting from 100.1 towards, say, 60.1 or 70.1 would still imply massive outperformance potential for silver.
Central banks are huge players in the gold market. What about silver?
That's a key difference. Central banks generally don't hold significant silver reserves. They are massive buyers and holders of gold, which provides a huge demand floor and unique status for gold. Silver, being largely demonetized, doesn't have that official sector support. Its price is driven almost entirely by private industrial and investment demand.
So occasional mentions like Russia potentially adding silver are outliers.
Exactly. Not a consistent large-scale driver like central bank gold buying is. If that ever changed, it would be a massive catalyst, but it's not the current reality.
So pulling all those drivers together, silver really is in a unique spot.
It's this hybrid. The growing industrial side ties it more to economic cycles and tech trends, sometimes decoupling it from gold. But that deep monetary memory keeps its precious metal, safe haven characteristics alive. It gets pulled by both growth and fear.
And that 4-year deficit we keep mentioning, does that suggest the market is finally getting really tight physically?
That's the logical implication. The fact that prices didn't absolutely explode back in 2021 or 2022 when the deficit started suggests that maybe above-ground stocks, recycling, or perhaps dynamics in the paper market were filling the gap. The strong rally we've seen in 2024 and now into 2025. That could be a signal that those buffers are running thin and the underlying physical tightness is finally exerting more direct upward pressure on the price.
Okay, let's shift gears to the practical side.
Yeah.
If someone's interested, how do they actually invest in silver? What are the main ways?
Generally, you've got two main routes. You can take direct ownership of the physical metal itself.
Like bars and coins.
Right. Or you can get exposure through financial products, mainly exchange-traded products, ETPs, which include things like ETFs.
Let's tackle physical first. Holding the actual metal, or knowing it's yours in a vault somewhere.
This means buying tangible silver. Bullion bars, they come in various sizes, or government-minted coins like American Eagles, Canadian Maple Leafs, or privately minted rounds and bars.
What's the big appeal of going physical? Why do people choose that?
The number one reason is usually tangibility and direct ownership. You physically hold the asset or have direct title to specific allocated bars. You control it. This completely eliminates counterparty risk.
Meaning you're not relying on a financial institution staying solvent.
Exactly. No bank, no broker, no fund manager in between you and your asset. It's also seen as the purest form of a store of value and inflation hedge, something tangible outside the financial system. And generally, physical silver is recognized and can be sold pretty much anywhere in the world, though the ease can vary.
But it's not without its downsides. There are definite drawbacks.
Oh, absolutely. Significant ones. Storage is the big one. You need somewhere secure, a good home safe, a bank deposit box, maybe a specialized non-bank depository. That costs money or involves risk. Insurance is another potential cost. And because silver is bulky compared to gold for the same value,
Right, lower value to weight ratio.
holding a substantial amount takes up a lot more space and weighs a lot more, logistically more challenging than gold.
And there are costs when you buy and sell too.
Yes, premiums. You almost always pay a price above the fluctuating spot price when you buy physical silver. This premium covers minting, distribution, the dealer's profit margin. It can be, 5–6% easily, sometimes more, sometimes less, depending on the product and market conditions.
And selling might involve a discount.
Often you'll sell back to a dealer at slightly below the spot price or pay a commission. Plus, physical silver doesn't pay any interest or dividends. Your profit only comes if the price goes up, and there's always the risk of theft. And converting a large amount back into cash quickly at the price you want might not be instant.
The source called these the convenience costs of physical.
That's a good way to put it. You're basically paying those premiums, storage fees, maybe insurance, dealing with potential liquidity friction, in exchange for that direct control, tangibility, and freedom from counterparty risk. For many people, especially those with a long-term view or concerns about the financial system, that trade-off is worth it.
If someone decides they want to buy physical, what are the key things to keep in mind?
Number one, absolutely crucial. Buy from reputable dealers. Do your research. Check reviews, look for established businesses, maybe ones that offer educational resources. Compare their total cost to the price, including commissions, fees, shipping, insurance. Online dealers can often be very competitive.
Are certain brands or types better?
Stick with well-recognized names. Government mints like the U.S. Mint, Royal Canadian Mint, Perth Mint are trusted. Reputable private refiners include names like Asahi, Valcambi, PAMP, Sunshine Minting. Look for bars clearly stamped with weight. Purity usually 0.999 or 0.9999, find the refiner's mark, and often a serial number on larger bars.
IRA eligibility can be a good indicator of quality.
Yes, if a product meets the stringent fineness standards required for inclusion in a U.S. precious metals IRA, that's generally a good sign of its authenticity and quality.
What about paying and premiums?
Dealers usually accept various methods, checks, wires, sometimes credit cards, often with a fee, maybe crypto or PayPal. Premiums vary a lot. Generally, bars have lower premiums per ounce than coins, and larger bars, like 100-ounce bars, have lower per ounce premiums than small 1-ounce bars. The advice is usually to avoid tiny bars, like fractionals or 1-gram bars, because the premiums are disproportionately high. For most people, 1-ounce, 10-ounce, or 100-ounce bars or standard 1-ounce sovereign coins offer a good balance.
So buying physical isn't like clicking buy on a stock. It requires more homework on the seller.
Absolutely. The physical market involves many dealers. Reputation matters hugely, not just for price, but for authenticity, reliability, and maybe ease of selling back later. It's a different kind of due diligence.
Okay, the other main path is silver ETPs, exchange-traded products. EPS are the most common type. How do they work?
ETPs basically let you track the price of silver without actually having to handle the metal. The most common ones are physically backed ETFs.
Physically backed means they actually hold silver bars.
That's the structure, yes. Funds like SLV, iShares Silver Trust, or SIVR, Aberdeen Standard Physical Silver Shares ETF, aim to hold physical silver bullion, usually large bars, in secure vaults run by custodians, often big banks. When you buy a share of the ETF, you own a tiny fraction of that pool of silver.
Are there other types, like synthetic ones?
Yes, though less common for just tracking the spot price. Some ETPs might use derivatives, futures contracts, options, swaps to mimic silver's price movements without holding the physical metal. These tend to be more complex and carry different risks, like counterparty risks specific to the derivative issuer.
And these ETPs trade on stock exchanges.
Exactly, just like regular stocks. That's a major appeal. You can buy and sell them easily throughout the trading day. High liquidity. The fund manager handles all the logistics, buying the silver, storing it securely, insuring it, arranging audits. The cost for all that is built into the fund's expense ratio.
But owning shares in one of these physically backed ETFs, it's not quite the same as owning the bars yourself, is it?
It's a critical distinction and one people really need to understand. You own shares in a trust or a company that claims to own the silver. You don't own the specific bars. There are layers between you and the metal. The fund sponsor, the trustee overseeing the fund, the custodian bank holding the metal.
So due diligence is still needed, just different?
Yes. You'd want to look at things like, how often are the holdings audited? Who is the custodian? Is the silver held in allocated accounts, meaning specific bars are set aside for the ETF, or unallocated accounts, more like a general claim on the custodian's pool of metal? And crucially, for almost all retail investors, you cannot redeem your shares for the actual physical silver. That option is usually only available for very large blocks of shares, typically by authorized participants like big banks.
And there have been cautionary tales related to financial intermediaries holding assets for clients.
History has examples, like the MF Global collapse years ago, which raised questions about segregated client funds. While ETF structures are designed with safeguards, it highlights that relying on intermediaries always carries some level of counterparty risk, even if it's considered low for major regulated ETFs.
So what are the main advantages of using ETPs then?
Liquidity is probably the biggest. Easy to buy and sell quickly at prevailing market prices. Cost effectiveness can be another. Brokerage commissions are usually low, much lower than typical physical premiums, and you don't have direct storage or insurance costs. The expense ratios on major passive, physically backed silver ETFs are often quite low, maybe 0.2% or 0.5% per year. Ease of access is huge. You can buy them in a standard brokerage account just like a stock. And it makes diversification within a larger portfolio very straightforward. No storage hassles.
Okay, what about the downsides or risks of ETPs?
Counterparty risk is the big one we just discussed. You're relying on the issuer, the trustee, the custodian. Even with physical backing, that reliance exists. There are also ongoing concerns among some investors about whether these funds are always fully backed by easily accessible, allocated physical metal. Management fees, those expense ratios, while seemingly small, do add up over time and reduce your net returns.
Tracking error. What's that?
That means the ETF's share price might not perfectly mirror the spot price of silver. This can happen due to the expense ratio, transaction costs within the fund, maybe holding small amounts of cash, or for synthetic ETFs, costs related to rolling futures contracts. It's usually small for major ETFs, but it exists.
And the fact you don't actually own the metal is a philosophical issue for some.
For many, yes. You own a share, a paper claim, not the physical thing. You can't take delivery. And this ties into another persistent concern in the silver world, potential price manipulation.
Ah, yes, the manipulation concerns.
There's a segment of the market, particularly those favoring physical, who believe that large institutions can use the paper market's futures, options, maybe even trading in unallocated accounts or ETF shares to influence or suppress the recorded spot price, potentially disconnecting it from the real physical market, especially during times of stress. It's a complex and debated topic, but the perception of this risk definitely exists and influences investor behavior. It's a distinct risk factor to consider.
Taxation can also be tricky with ETPs.
Can be. In the U.S., for example, gains on many precious metals, ETPs are often taxed as collectibles at a higher maximum rate, currently 28%, rather than the lower standard long-term capital gains rates. That can be a significant difference. It depends on the specific fund structure. And remember, VAT can apply to physical silver purchases in many countries outside the U.S., so tax implications need careful checking.
So physical versus ETPs. It really boils down to individual priorities.
Absolutely. The source material makes that clear. There's no single best way. It completely depends on what you value most, your risk tolerance, how long you plan to invest, and maybe even your general outlook on the financial system.
It's that fundamental trade-off. Tangibility, direct ownership, no counterparty risk with physical.
Oh, versus the liquidity, convenience, generally lower transaction costs, and ease of access with ETPs.
So if you're thinking short-term trading, maybe ETPs make more sense. If you're thinking ultra-long-term wealth preservation, maybe physical.
That's often the thinking. The upfront premiums on physical become less significant if you hold for decades. Investor knowledge matters too. Physical requires more effort finding dealers, arranging storage. ETPs are simpler via a broker. And your risk view. If you're deeply worried about systemic financial risk, the security of physical might feel worth the extra cost and hassle. If you're comfortable with regulated markets and intermediaries, ETPs offer undeniable ease.
The source also mentioned a hybrid strategy.
Yeah, and that makes a lot of sense for some people. Maybe hold a core position in physical silver for that bedrock, long-term security outside the system hedge. And then maybe use ETPs for more tactical trading, smaller allocations, or perhaps within retirement accounts where holding physical can be complicated or costly. It lets you tailor your approach.
Okay, let's broaden the view again. Where does silver fit in the bigger investment picture? How does it stack up against its big sibling, gold?
This brings us right back to that gold-silver ratio, the GSR. It's the most direct comparison. Gold price divided by silver price.
And historically way lower when silver was money.
Yeah, 12.1, 15.1, 15.5.1 fixed by law. 20th century average maybe 47.1. And now, June 2025, around 75.1, having come down from over 100.1 earlier in the year.
And the common interpretation is that a high GSR means silver looks cheap relative to gold.
That's how many precious metals investors read it. A ratio over 80, or especially over 100, is often seen as a signal that silver might be poised to outperform gold on a percentage basis, assuming the ratio reverts somewhat towards a more typical historical level.
And it does tend to revert from extremes.
History shows a strong tendency for that, yes. Those spikes above 191 in March 2020 were followed by strong silver outperformance that brought the ratio down. Now, expecting a return to 15.1 is probably unrealistic given how their roles have diverged silver's industrial focus, gold, central bank status. The mean it reverts to might be higher now, but even a move from 100 back towards, say, 60 or 70 still implies significant silver outperformance potential.
Beyond the ratio, how do they compare on core investment characteristics?
Volatility is the big one. Silver is way more volatile than gold. Its price swings can easily be 2 or 3 times larger percentage-wise. Think of it like a higher beta asset, maybe around 1.5 versus gold closer to 0.8. It tends to magnify market moves more.
And the market itself is smaller for silver.
Much smaller and less liquid. The London gold market turnover is estimated to be something like 18 times larger than silver's. Global gold ETF assets dwarf silver ETF assets, maybe $230 billion versus $18 billion. That smaller size makes silver easier to push around by large flows, contributing to the volatility.
How do they correlate with other assets, like stocks?
Silver tends to have a moderately weak positive correlation with stocks, bonds, other commodities. Gold is better known for having little correlation or even a negative correlation, especially during market turmoil. That makes gold often seen as the pure diversifier in a traditional portfolio. Silver offers diversification too, just maybe less consistently uncorrelated than gold. Gold also typically has a stronger inverse link to the US dollar.
So silver as the high beta precious metal sums it up.
It's a pretty good shorthand. Potential for bigger percentage gains than gold when metals are rising, but also potential for bigger percentage losses when they're falling.
Let's unpack the implications of their different industrial uses again. That's key.
Absolutely fundamental difference. 55% or more of silver demand is industrial. For gold, less than 10%. This ties silver's fortunes much more closely to the economic cycle, to tech trends, to things like solar installations and EV production. It gives silver a growth story linked to tangible economic activity that gold mostly lacks.
Whereas gold is the classic safe haven.
It's the undisputed heavyweight champion of safe havens. When things get really scary, investors flock to gold. Silver has safe haven qualities too. People definitely buy it during crises. But that big industrial component is a potential drag if the crisis involves a severe economic slump that crushes industrial demand. Gold doesn't have that conflict.
What about as inflation hedges?
Both are seen as inflation hedges historically. Gold is generally considered the more reliable or primary one. Again, because its value isn't so tied to industrial activity, which could suffer during inflationary recessions, stagflation. If you get high inflation and an industrial slowdown, silver might lag gold as a pure purchasing power preserver.
Price is a practical difference. Silver is much cheaper per ounce.
Makes it far more accessible for small investors wanting to buy physical metal. Easier to stack ounces. But again, that lower value density means storing, say, $50,000 worth of silver takes up vastly more space and weighs much more than $50,000 of gold.
And the central bank demand difference is huge.
Critical. Central banks are constantly buying and holding massive amounts of gold, providing a steady demand floor and global validation. Silver lacks that. Its price is almost entirely set by private demand. A shift where central banks started buying silver would be revolutionary, but it's not the current reality.
So silver's appeal is really this unique blend.
It's a hybrid, strong, growing industrial demand linked to the future economy, plus that ancient monetary legacy providing safe haven appeal. It attracts people interested in tech growth and people looking for a store of value. It can potentially benefit from both fear and growth, which is fascinating but also makes it complex.
Okay, let's do one more comparison. Silver versus just keeping money in a regular bank savings account. Seems basic, but highlights different goals.
It really does. They serve fundamentally different purposes and carry totally different risks. Savings accounts are about preserving nominal capital and having immediate access. Silver is about potentially growing capital and preserving purchasing power over time while accepting volatility.
Capital appreciation potential is the starkest difference.
Night and day. Silver has the potential for huge gains, like that near 95% rise from May 2020 to May 2025 mentioned in the source, but it can also fall significantly. A savings account offers minimal growth via interest, usually nowhere near enough for significant wealth building.
And inflation hedging.
This is where silver shines compared to cash. Silver aims to protect your purchasing power against inflation over the long run. Cash in the bank is guaranteed to lose purchasing power if inflation is higher than the interest rate you earn. Your nominal dollars are safe, but what they can buy shrinks.
So completely different risk profiles.
Totally. Silver has market risk, price volatility risk, maybe physical storage risks or ETP counterparty risks, but it mitigates purchasing power risk from inflation. A savings account has very low nominal risk. Your dollar amount is safe, often insured, but carries high inflation risk. The risk your money becomes worth less in real terms.
Liquidity is different too.
Yes. Savings accounts are highly liquid, cash on demand. Silver ETPs are also very liquid. Physical silver can take more time and effort to sell at the price you want.
And income generation.
Yeah. Silver pays nothing. No interest, no dividends. Returns are purely from price increases. Savings accounts pay a little interest, but often less than inflation, and it's taxable.
So the core trade-off is silver for potential growth and inflation protection, accepting volatility and no income, versus bank savings for nominal safety and instant access, accepting likely loss of purchasing power.
That's exactly it. A savings account is a cash management tool, essential for emergencies and short-term needs. It's not really an investment for growth or long-term wealth preservation. Silver is an investment asset class, volatile, but with potential for real returns and acting as a hedge.
And which looks better depends heavily on the economic environment.
Absolutely. Low inflation, positive real interest rates. Savings accounts look relatively safe and appealing. High inflation, negative real interest rates. Holding cash guarantees you lose buying power, making assets like silver, despite the risks, potentially much more attractive for preserving or growing real wealth. It's a dynamic choice.
Okay, let's pull all these threads together. Can we summarize the key potential rewards of investing in silver?
Sure. Top of the list, portfolio diversification. Its price often moves differently from stocks and bonds, potentially lowering overall portfolio risk, especially during market stress. Then there's the inflation hedge aspect, protecting purchasing power over time.
And that growth potential from its unique industrial role.
Crucial. Exposure to those high-growth tech sectors, solar, EVs, 5G, electronics, where it's often indispensable, that provides fundamental support and a link to future economic growth. For physical holders, there's the reward of tangible asset security, direct ownership, no counterparty risk.
It's more affordable than gold, ounce for ounce.
This makes it accessible for smaller investors. And because of its higher volatility, there's the potential for greater percentage returns than gold during bullish phases. Plus, it still retains those historical safe haven qualities for times of crisis.
So that hybrid reward profile again. Defensive hedge plus offensive growth potential.
Exactly. It can potentially benefit from both fear, safe haven, and growth industrial, which is quite unique.
But we absolutely have to balance that with the significant risks involved. Let's recap those.
Number one risk, price volatility. It's much higher than gold, much higher than many traditional assets. Sharp swings are common, driven by industry shifts, speculation, sentiment. For physical silver, you have the ongoing costs of storage and insurance eroding potential returns.
And for ETPs, counterparty risk is the big one.
Yes, relying on the fund issuer, the custodian bank, plus potential risks around how the underlying silver is actually held, allocated versus unallocated. Market sentiment and speculation also play a big role due to the smaller market size, potentially causing prices to disconnect from fundamentals temporarily.
Regulatory and tax issues, too.
Can be complex. Potential for higher tax rates, like the U.S. collectibles rate, VAT on physical in some places. And we have to mention those persistent concerns about potential price manipulation, particularly in the paper markets. Whether real or perceived, it affects investor confidence and behavior.
Other risks include liquidity challenges for physical, especially large amounts, and the fact that it generates no income.
Right. No yield, profit only from price appreciation. And finally, the risk of a major downturn in key industrial sectors that rely on silver, or, less likely but possible, unexpected large new supply discoveries.
So, bringing this deep dive to a close, silver really does embody this incredible duality, doesn't it? That ancient monetary heritage, safe haven, inflation hedge potential, meeting this absolutely critical, growing role as an indispensable metal powering future technology.
It's a powerful combination, creating a truly unique investment case. And the current market backdrop, that strong recent performance, the backdrop of persistent deficits, the generally bullish though varied analyst outlook, certainly makes silver a topic worth understanding right now.
And investors have clear choices, each with pros and cons. Physical for tangibility and security, but with costs and potential friction. ETPs for liquidity and convenience, but with counterparty and tracking risks.
Or that hybrid approach, trying to get the best of both worlds depending on your specific goals. There really is no single right answer.
The long-term fundamental story, driven by silver's non-substitutable role in green energy, EVs, 5G, all that future tech, seems quite compelling, coupled with its traditional appeal.
Those factors create a strong demand picture, especially against the backdrop of relatively constrained, inelastic supply growth.
But, and it's a crucial but, investors absolutely must respect its characteristic volatility and understand the full range of risks, industrial slowdowns, market structure concerns, everything we've discussed.
Absolutely essential. So as you think more about silver, its place in the world, and maybe its place in your own strategy, here's a final thought to chew on. How will silver navigate being at this unique intersection, the very future of technology on one side and the ancient stability of money on the other? Can it truly bridge both worlds effectively? And how will its price ultimately reflect that fundamental tension in the years ahead?